and ultimately reflect the economic experience of a business into the price of its stock. Knowing this, investors therefore focus on solid long-term business analysis and conservative reasoning. That's what we believe leads to above-average results over time. This big foundational principle comes directly from Ben Graham, Buffett's teacher, former employer, hero, and the man who practically invented securities analysis. Known as the Dean of Wall Street, Ben Graham was a revolutionary, the first to turn what had formerly been somewhat of a dark art into a real profession. Buffett was consumed by Graham's ideas from the moment he encountered them, so much so that he even named his son, who was in line to become the next non-executive chairman of Berkshire Hathaway, Howard Graham Buffett. Grasping Buffett's investing principles, the part that's remained constant from the partnership years all the way through to the present day, requires a firm understanding of several of Graham's foundational ideas and influences. Here's how it all began. Buffett graduated a year early from the University of Nebraska-Lincoln in 1950 at the age of 19. He then applied to Harvard Business School but was told he would have a better chance if he reapplied in a few years. Getting turned down by Harvard was one of the luckiest things that ever happened to him. As he began looking at other business schools, he came across Columbia's catalog. In it, he discovered that the author of his favorite book, The Intelligent Investor, was not only alive but also teaching there. Buffett immediately applied. Several weeks later, he applied in August, he was enrolled at Columbia, and not too long after that he was sitting in Graham's classroom as the star pupil. One can only imagine the intensity of the intellectual dynamic between these two men. Graham was laying Buffett's intellectual foundation, and Buffett, the only student to get an A+, was picking up on everything Graham was putting down. After graduation, Buffett was absolutely desperate to work for Graham's investment company, but, as he later joked, he was turned down for being overvalued, despite an offer to work for free. The real reason he didn't get the job was probably more linked to Graham Newman being one of only a few Jewish-owned investment companies. Buffett could get a good job elsewhere, but other highly qualified Jews, if turned down by Graham, might be otherwise shut out. Disappointed, he returned to Omaha to join his dad in the securities brokerage business, where he continued pursuing the idea of working with Graham. A 3-year steady stream of letters and stock ideas was all it took. His mentor finally relented and invited him back to New York in 1954. Buffett didn't get much time at Graham Newman, though. A year after he joined, Graham decided to retire. Once again, now at the age of 25, Buffett returned to Omaha, although this time he didn't return to brokering stocks with his dad again. This time, against the advice of both Graham and his father, he started an investing partnership of his own. He structured it in the image of what Graham had set up and operated it mostly according to his principles. Graham and Buffett remained very close all the way through Graham's passing in 1976. Mr. Market. Graham's most valuable explanation of exactly how short-term market inefficiency works was crystallized in his concept of Mr. Market. The idea is that a securities market can be thought of like a moody, manic-depressive fellow who stands ready to buy or sell you a half stake in his business every day. His behavior can be wild and irrational and is difficult to predict. Sometimes he's euphoric and thinks highly of his prospects. Here, he'll offer to sell you his stake only at the highest of prices. At other times, he's depressed and doesn't think much of himself or his business. Here, he offers to sell you the same stake in the same business at a much lower bargain price. Oftentimes, he's neutral. While you can never be sure what mood you will find him in, you can be sure that regardless of whether you trade with him today, Mr. Market will be back again with a new set of prices tomorrow. Viewing the market through the lens of Graham's allegory reveals why the market price on any given day should not inform our view of a security's underlying intrinsic value. We must arrive at that figure independently, and then only act when Mr. Market's mood is in our favor. That is what Buffett is driving home in his letters when he teaches